Hello all, welcome to this new quarterly webinar session. We are going to wait 1 minute to let more people coming in. So welcome to those who just joined. It's no time to launch the first Energy Scan webinar session of 2024. I'm Julien Waro. I'm in charge of the Energy Scan platform here at NG Global Energy Management and Sales. And today we'll talk about the 2024 outlook for energy markets, notably as 2023 has been marked by a sharp decrease in wholesale energy prices after the historical peak of 2022. 2024 starts with the continuation of this bearish trend despite the onset of a cold weather episode in Europe at the moment and lingering geopolitical risk on the supply side. So in this session, we'll give you the key elements to understand what could happen in the coming months with our speakers. Olivier Gasnier for macroeconomy, Étienne Covin for power, and François-Yves Ducouré, who joins us for the first time to comment on the gas market. Welcome on board, François-Yves. So this new year goes with a new webinar tool for us and new features for you. So check out the buttons on the bottom right corner of your screen to ask questions to our speakers or chat with participants and leave suggestions to the team. We'll do a Q&A session at the end of each presentation. And I remind you that the session will last 90 minutes to take as much questions as possible. Finally, you will also be asked to fill a one question satisfaction survey at the end of the session. The slides and the replay of the webinar will be available by tomorrow at the latest on our Energy Scan platform, but you can already download them by clicking normally on the cloud icon on the top right corner of the screen or following the instructions displayed here in this slide. So before we start with the macroeconomic and oil outlook, I'm going to ask you to answer a one question poll on the macroeconomic context. So how many times do you think the Fed, so the US Central Bank, and the ECB, the European Central Bank, will cut interest rates in 2024? So is it 0, 3, or 6 times? So thank you for those who answered the survey. So we see a large majority of people answering 3 times, which should be in line with central bank guidance. But we see what Olivier has to talk about that. Olivier, welcome. The floor is yours now.
Welcome. Hello, everyone. Hello, Julien. Thank you. To start, I have to confess that I've rarely been so indecisive when it comes to making a forecast at the start of the year. Of course, there are always uncertainties, and there are plenty of them today on the geopolitical front, for example. But what's really difficult in this case today is that a number of economic indicators are giving contradictory signals, and it's really very difficult to disentangle them and draw any conclusions that appear solid. So I'm probably going to express a lot of doubts this morning, and I'm going to try to give you a food for thought rather than trying to convince you. Having said that, let's get straight to the point, the 24 outlook. So what will we learn from the year 23? Firstly, after a year of soaring inflation in 22, disinflation has been strong, as you can see, minus 4 points on average in the US, minus 3 points in the Eurozone. And despite this, the central banks have continued to tighten their monetary policy until this summer for the Fed, the ECB, and the Bank of England, which was the most severe tightening of financing conditions for the economy in these countries for 40 years. It's important to keep that in mind for 24. Generally speaking, growth has held up better than expected, but this was not the case for the Eurozone, where Germany has dragged the area down. And why did this happen? Because German industry is facing a triple crisis, rising energy costs, the slowdown in international trade, and the transition to electric cars. German GDP has contracted by 0.3% in 23, and growth in the Eurozone will not exceed 0.5%. So this is clearly much less than in the US, where growth has been close to 2.5%, with consumer spending growth 3 points higher than in the Eurozone. And there are two main reasons for that. Disinflation was stronger in the US, and US households continued to draw on the savings reserve build up during the pandemic. As a result, the monetary policy was much less effective than expected. There is another reason which also applies to Europe. Unemployment has not risen. And this is probably also one of the consequences of the COVID crisis, which has pushed many people away from the labor market. But all that is not at all typical of what has happened in Asia, as the Chinese economy has disconnected itself from the global economic cycle with its anti-COVID policy. The end of the restrictive measures enabled recovery in 23, but this recovery was disappointing because the Chinese economy still had to fight the poverty bubble. Unlike the US and European economies, which want to get rid of inflation, Japan wants to put an end to deflation, and China does not want to follow Japan's path of the last 3 decades. So the situations are very different, and we can see that the world economy is starting 24 in a very disorganized manner. So the first question we need to answer about the outlook for 24 is, has inflation been beaten? And the answer partly determines the second question, which is, are the market expecting too much from central banks? Disinflation has been very strong due to energy pricing, but the fall in core inflation has been much less so. It remains high, as you can see on the chart on the left, but latest trends suggest that it's in the process of normalizing in the Eurozone, while in the US, it's still around 1/10 per month higher than it was before COVID and, of course, the war in Ukraine. This is shown in the chart on the left. And if this continues to be the case, and the resilience of the labor markets in the US is pointing in this direction, core inflation will find it difficult to fall below 3.5%. Furthermore, it's difficult to speculate on what will happen in the Red Sea right now, but recent events have undoubtedly pointed in the direction of additional inflation in 24. So, what will the central banks do? This was our first question, the question of the survey. As you have noticed probably, the ECB and the Bank of England are maintaining a cautious stance, stressing the need for more guarantees on disinflation before cutting rates. The Fed has given the signal of a future cut, but a relatively moderate one, which is equivalent to 3 cuts of 25 basis points in 24. By contrast, the markets are extremely aggressive in their expectations, with 5 to 6 rate cuts by the Fed starting in March, as can be seen in the chart on the left. These expectations supported the equity market and pushed down long-term interest rates at the end of last year, therefore creating favorable conditions for a recovery, but also posing the risk of a severe correction in the market if the Fed were unwilling or unable to validate these expectations. And we have had a foretaste of this since the start of the year. The market have their doubt and are heading into 24 in a gloomy mood, as you have probably noticed in the last few days. However, I think it's important to bear in mind that real interest rates have risen sharply as a result of disinflation. We can see this in the chart on the right. It is as if monetary policy, in a way, has continued to tighten over the last 6 months, while key rates have remained stable. As far as the Fed is concerned, there is also the political variable that is to consider. I mean that the Fed is apolitical, of course, but cannot be insensitive to the fact that a return to power of Donald Trump would certainly threaten its independence. If it wants to support economic activity, and of course, and indirectly Joe Biden, it must act quickly. So the very next employment and inflation figures will really be crucial in the US. So we can, of course, notice that the likelihood of a rate cut as early as March has receded recently, but in my opinion, it's not completely impossible to see the Fed acting rather soon in the coming months. So, about the US economy, can we believe in a soft landing for the US economy? There are, in my opinion, 3 scenarios at least that can be defended today. The first is that of a recession, clearly heralded by a few indicators, such as the 20 months decline in the Conference Board leading indicator, or the sharp and worrying fall in the ISM Services Index in December, or very recently this week, the New York Fed Index in January that plunged for unknown reason. The second scenario is a soft landing, that is to say a slowdown in the economy as a result of the past rise in interest rates, accompanied by disinflation, but without a recovery in unemployment. This is known in English as immaculate disinflation, a kind of miraculous disinflation with no harmful consequences on activity. This is, of course, the ideal scenario. The final scenario is one of resilient inflation. In that case, the Fed lowers its guard too quickly, and inflation picks up again because the labor market remains tight and the demand strong. The negative consequences would be more likely in 25 with a new phase of monetary tightening. The path to a soft landing is therefore very narrow between these 2 pitfalls, and today no scenario really stands out. Even so, a scenario of immediate recession has become less likely given the strength of US activity indicators. Next question, is the worst over for the Eurozone? In simple terms, activity in the Eurozone has been at a standstill since the end of 22. Technically, there is a risk of a recession, that is to say 2 consecutive quarters of decline, if Eurozone GDP contracted in Q4 23, and this is clearly possible since German GDP is estimated to have fallen by 0.3% according to the first official estimates. What we can see, however, is that the surveys have stopped deteriorating, even in industry. And for example, here you can see the PMIs, but it's also the case for the EU survey, for example, or national surveys such as INSEE in France or IFO in Germany. We are also seeing a slight strengthening of credit in the Eurozone at the end of 23, which we did not expect to come so soon. And you can see the small rebound of credit on the left-hand charts. Very small so far, but the downward move has been interrupted. So, bearing any unforeseen events, we are tempted to conclude that the worst is over indeed for the Eurozone. But you have to keep in mind that the consequences of past monetary tightening will continue to be at play, and so growth will be no better in 24 than in 23, which is still, of course, very weak. You cannot envisage a growth of more than 0.5%, probably very close to 0% in 24. And finally, to conclude this rapid tour of the world, a few words about China. Its GDP grew by 5.2% in 23, according to data published yesterday. But the Chinese economy is clearly suffering from a lack of consumer spending, as households are saving in the face of the fall in the value of their property, which is intensifying, as the graph on the right shows. Or the fear of bankruptcy of a property developer to whom they have already prepared for their home, for example. The graph on the left shows that month after month, Chinese consumers are consuming less than before the crisis. You see the difference compared to the period 2015-19. To date, the problem is that the stimulus measures put in place by the authorities continues to focus on investment. And they have reaffirmed that there won't be any huge recovery plan that would be put in place. So the GDP growth target that is likely to remain around 5% on average this year will be very difficult to meet. It seems to us that there are a few good surprises to be expected from China. And what is worrying is that prices are tending to fall. Inflation was minus 0.3% in December, and not just property prices. Hence, the analogy that is often drawn between China today and Japan in the late 80s, when the property and stock market bubble burst, foreshadowing 30 years of deflation. So all in all, it should be noted that we have raised our forecast, nevertheless, for 24, particularly for the US. However, as I said at the beginning, I believe that these forecasts are very fragile and that there are alternative scenarios in the US with a non-negligible probability, that is to say a classic recession resulting from monetary tightening or a recession postponed due to the persistence of inflationary pressures that needs to be resolved at a later date, not to mention the geopolitical risk, of course, if transport costs or energy prices were to soar in the coming months. So, inflation, geopolitical risks, this is a really good transition to the oil market. At the time of the last Energy Scan webinar, the war between Hamas and Israel had just broken out. Until early December, this conflict had little impact on prices, as you can see. They remain driven by concern about the future direction of demand, particularly from China. The price of Brent crude fell as low as $72 per barrel on the 13th of December, and it was not the geopolitical tensions that caused prices to rebound at that time, but the Fed meeting, which boosted expectations of rate cut. And then only things started really to deteriorate in the Middle East with the Yemenite Houthi rebels attacking cargoes or tankers in the Red Sea. Since then, prices have fluctuated in a range of around $5 per barrel, which can be described as a geopolitical risk premium. In the absence of tensions, prices return to around $75 per barrel. At the height of the tensions, prices are approaching or even exceeding $80 per barrel. This is more or less what we have observed since the start of the year. So, as I said, of course, tensions have risen sharply without triggering a marked increase in prices, not more than $80 per barrel. The main consequence of the attacks by Yemeni rebels on transport vessels in the Red Sea is that a growing proportion of the fleet is being diverted from the Suez Canal to the Cape of Good Hope. This is the chart on what shows the chart on the left for oil, which increases, of course, the length of the journey by around 10 days and push up shipping costs. These are the cost of container transport on the chart on the right. You have many indicators about that. So I've taken this one because it was not too much volatile and shows clearly the rebound in the cost of freight. And of course, this rise comes at the worst of possible time as it risks boosting inflation. However, oil is probably one of the commodities that has been spared the most, as tankers carrying Russian oil or oil product from Indian refineries that they produce from Russian oil they have bought before. All this transportation is probably under a little threat from attacks from the Houthi rebels. Next question, as the OPEC, which has managed to support prices by cutting output since the start of the second half of 23, lost control of the market. The latest announcement at the end of November of voluntary production cuts of minus 0.9 million barrels per day in Q1 24 have not had any impact for several reasons on markets. The first reason is that the potential cut is probably much smaller. As you can see on the table, it's only 0.6 million barrels per day because producers of OPEC were producing less than what their target before. Saudi Arabia, second reason, no longer wants to cut its production any further and lose market share. And that was confirmed last week by the sharp fall in its selling prices to consumer in February. Third reason, producer countries have shown their disagreement there are many tensions inside the organization, and that has led to Angola's departure from the organization. And the last reason is because Russia's compliance with the OPEC Plus agreement is still difficult to confirm. It has been the case for many months. On the latest pledges of cuts relate to oil products, not crude. So it will still be difficult to really assess if Russia complies with these new pledges. And of course, if OPEC Plus production does not fall as promised in January, prices will be dragged down, all other things being equal. However, nevertheless, unless demand estimates turn out to be far too optimistic, it does not appear that OPEC will have to make a huge effort to balance the market in our view, even if US production continues to rise somewhat this year. So this table shows that the market could remain in a slight deficit this year, as can be seen from the forecast fall in inventories you see on the right, based on the following assumptions. First, OECD demand growth reduced by 2/3 compared with 2023. That is to say, plus 0.5 million barrels per day versus plus 1.7 million barrels per day. This is a rather conservative forecast. Second, non-OECD demand growth reduced by 50%, plus 1.1 million barrels per day only. And that would be linked to the fact that the Chinese demand growth in 23 was linked to a sharp rise in inventories. Other forecasts, US production growth would continue, plus 0.6 million barrels per day. That's significant. And OPEC Plus output cut would be limited to 0.5 million barrels per day in the first half of the year before a gradual rise in the second half. So these are not very extreme forecasts, and you can see that even if you take these relatively conservative assumptions, the market would still remain in deficit. This is the reason why we are assuming that oil prices will probably stabilize and then rise slightly in 24, with an upward risk due to geopolitical tensions in the very short term. So, Julien, I think we can move on to questions now.
Yes, Olivier, thanks for the presentation. So don't hesitate to ask questions in the chat room, clicking on the questions icon. So one question, Olivier, regarding the Euro USD rate. What's the outlook according to you? Will we stay around the 1.10 mark?
Yes, I have recently revised upward my forecast. Maybe at the wrong time, because we have seen the euro dollar going back a bit below 1.10 following the downward revision in Fed rate cut expectations. But there is no big difference so far because the forecast for the Fed and the ECB are around 5 cuts for this year, 5 cuts of 25 basis points. Of course, I think the Fed will probably be more inclined, despite the economic situation that would point to an earlier rate cut by the ECB. The Fed is probably more inclined to cut rates than the ECB, for the obvious traditional reasons in the ECB, as many ECB members still the same, of course, don't want to take any risk with inflation or don't want to cut rates too early. While, as I have explained, the Fed, there are not only the inflation factor, but also maybe political factor that could push the Fed to act quite early and try to keep activity growing this year before the presidential election. So I would be tempted to think that the euro could increase a bit against the dollar, and that could see the euro dollar coming back above 110, going to 112, something like that in the coming months. There is a second reason, the second driver for the euro dollar, which is of course, the risk off mood on markets. When there is a risk off mood, it's always positive for the dollar. This is really the case right now, where markets have doubts. They are revising their forecast for ECB and Fed rate cuts or BOE rate cuts. They think they have maybe been too optimistic at the end of last year, and that is supporting the dollar. It doesn't need much to change this gloomy mood. If, for example, at the start of the year, there is a more clear decline in inflation in the US, and I think it will be the case for total inflation at least, you will see expectations of rate cut rebounding, the risk-on mode coming back to the fore, and probably the US dollar weakening a bit.
Okay, thank you, Olivier. And one quick question on the oil market. So you mentioned that the oil market should remain in slight deficit. What are the risks, according to you, to see an increase in Brent prices toward the $100 per barrel mark in case of a rebound in economic activity or supply issue on the back of the ongoing geopolitical tensions?
Yeah, I think, yes, the second factor probably is the main risk. To have really a worsening of the situation in the Middle East that could directly impact, for example, the comeback of the Iranian oil on market. I have not mentioned that. I think I mentioned that in the previous webinar, but one of the consequences of the war in Ukraine has been to bring back Iranian oil. Not all Iranian oil, of course, but more than 1 million barrels per day, which is significant on markets because, of course, the application of sanctions against Iran has been far less severe since we need Iranian oil on market to balance the market. And so, of course, one of the consequences of a clear worsening of the tensions in the Middle East could be to see those sanctions being applied strictly again, for example, or even worse, you could imagine direct consequences on the production sites in Saudi Arabia or Iran or Iraq, something like that, with really an extension of the conflict. That, of course, could push oil prices towards $100 per barrel very easily. If you look to demand, it's really more difficult. I mean, I have explained that I have taken a relatively conservative assumption for demand, but it's not easy either to have very optimistic assumption about demand. I mean, if you imagine that China will have some difficulties to achieving its 5% growth target, for example, it's difficult to have a very optimistic view on demand for this year. So I don't think stronger demand would be enough to push oil prices towards $100 per barrel. And moreover, you could also imagine that in that case, OPEC countries would probably quite quickly rather quickly boost their production that has been restricted for a long time right now.
All right. Thank you, Olivier, for your answers. It's now time to switch to the natural gas market outlook. And so we will start with a small poll once again before François-Yves takes the lead. So quick question on the current market trend on the European gas prices. You may have noticed that TTF front month prices have decreased a lot over the past few weeks. So at which price level the TTF Feb 24 contract will expire at the end of January, so in more or less 10 days. Is it above 30 euros per megawatt hour? Is it between 25 and 30 euros per megawatt hour, which is its current level? Is it between 20 and 25, or is it below 20 euros per megawatt hour? So let's have a look at the results. So most of you are seeing prices remaining in the current trading range, so between 25 and 30 euros per megawatt hour. So let's see if François-Yves has something to share about that. Welcome on board, François-Yves, for your first time with us.
Thank you,
The floor is
Julien.
yours now.
Thank you. Hello, everyone. Maybe first, I wish you a happy new year. So now is the focus about the natural gas market. Maybe we can start by a step back just to have a look at what happened to the European gas balance in the past year, so in 2023. So we have two parts in our gas balance, supply and demand, of course. If we focus on the left part of the slide, you have how supply just changed between 2022 and 2023. So in 2022, we had 443 BCM of gas supply for the whole Europe. And as you know, at the end of 2022, we lost Nord Stream 1, the Nord Stream 1 pipeline, which was moving strong volumes of gas from Russia to Europe. At the end of September, this pipeline just exploded under the water. And that is why for 2023, we have actually low levels of Russian gas supply. So that's the main change in the supply pattern in Europe. So minus 36 BCM of Russian gas. It's huge, but it's not the only change in the supply pattern in Europe. Another major change is about the Norwegian production and exports to Europe. In 2023, there was a very strong maintenance program in the Norwegian production and export system. And so it's lots of maintenances on lots of gas fields, but also processing plants, or it can be pipelines. And especially this year, the maintenance program drifted a lot. So what was expected in terms of maintenance was not exactly what realized, which is why we had lower levels of these Norwegian exports to Europe. Another change is on the domestic production side. In Europe, you know that several countries are gas producers. And this one is about mainly the decrease in production of Groningen, which is this big field in the Netherlands. It's actually a planned decrease due to the risk of earthquake in this country around the field. And the other change about the domestic production is about the United Kingdom, which is one of the major producer, and also just like Norway, had this unexpected maintenance which affected the gas production and then the deliveries to the European customers, especially of course in the UK. So just maybe a word about LNG. You can see that the LNG supply was stable in 2023 compared to 2022. The global change of supply between the 2 years is about 57 BCM. So it's huge. It's 30% of the supply of 2022. So we lost supply on almost every part of the supply balance. Now, if we have a look at demand, so we start, actually we end the 2022 year with a demand of the same level as supply, 440 BCM. And then we have several decrease in demand, which enabled us to balance the system. So the most important part of the demand decrease is the demand for gas to generate power. I will explain more maybe in the following slides how this gas for power demand has been affected by some changes in the power sector. Also, as you know, we had a lot of energy conservation measures in several European countries. So it had an effect on the demand from the distribution network. So it's the small consumers. And also the weather was favorable. So we had this also decrease in the distribution network consumption. And of course, the decrease in industrial demand, I will detail more maybe in the following slides. You can see on the very right part of the chart, this net injection in storage decrease, minus 26 BCM. It's actually because the storage level was very high at the end of 2022 because we attracted a lot of LNG and demand already decreased a bit. So storages were full and we did not need to inject too much. Now, very quickly, I guess you're familiar with the view on the European gas storages, but just to remind you a bit. So when in 2021, so we started to lose some of the Russian spot gas volumes. That's why it was before the war, of course. That's why in 2021, you can see it's the dark blue line. The level of the storage was quite low. So we finished this year quite low. And then in 2022, in February, we had the start of the Russian invasion of Ukraine. We were very low at 30% full in the European storage. Then prices just reacted dramatically. And LNG has been attracted to Europe due to this huge rise in gas price. So that's the blue line, the light blue line. We have this very impressive increase in the European gas storages. Then we finish very high at the end of 2022. In 2021, we still we continue to reduce demand, and that's how we reached a historical high at the end of the injection season in 2023, historical high of 105 BCM. So it's almost full capacity, the highest level if or reached actually. And now we are at the left part of the chart on the orange line. So the current level is still a historical high compared to this range, which is in gray in the graph. That's the minimum and maximum levels that were observed in the year 2016 to 2023. So right now, the European gas storage level is very high, 84 BCM. It's about 78% full. And the weather is quite okay actually. So we had some snow this morning in Paris and this night, but the weather is going to start warming from next Monday actually. So it seems to be cold, but the weather is mild. Just to say that European storage are very high. Now, storage are high, but how is demand? As I said, demand is actually weak in Europe. So there is several parts in demand, of course. So demand for the power generation, gas demand for the industrial customers, and gas demand for the small clients, actually small consumers. Just to go quickly on this one, so the gas demand for the power generation actually was affected by the increase in the renewable capacities penetration, so wind and solar. We know that in 2023, there was an increase of 68 gigawatts in the European Union compared to 2022, 68 gigawatts of solar and wind capacity. So impressive move. Again, you probably heard about the story about the nuclear production in France. So this year, France increased its nuclear production. That's why there was not the same need to produce power with gas. And also the hydropower fundamentals are quite good because the weather at the end of last year was really not dry. It rained a lot, so the hydro is okay, and the power load is rather low actually. For instance, in France, in 2023, the power load decreased by 6%, so quite impressive again. Now, if we have a look at the distribution network gas demand, the decrease was driven, of course, by the weather, but also the fact that prices and energy conservation measures just gave the incentive for small customers to reduce their consumption. Also, there is this biomethane injection, biomethane production and injection in the distribution network is actually decreasing the demand for natural gas. So that's an interesting lever and very green, and very transition compatible. And lastly, of course, the heat pump penetration, people that just switched from gas to heat pumps in their homes. And the last type of demand, so industrial gas demand, it's actually very dependent of the macroeconomic fundamentals, which are not very good. That's why this demand is rather low and seen to remain not very high. And it is also affected by the natural gas price, of course. And just to give you a figure, this demand reduction, this really the demand destruction compared to the pre-crisis level, for the industry is about 21%, minus 21%. And for the small customers, it's about minus 10 to 15%. The real question is, we expect prices to decrease, but what will be the response to low gas prices? There might be a level at which maybe demand is increasing because the price is too low. Just to give you a quick word about LNG. So as you know, in 2022, LNG has been LNG imports have increased a lot in Europe. So about 62 additional BCM coming to Europe in 2022 compared to 2021. And this increase in LNG has been possible because some Asian countries actually decreased their imports of LNG, and also some LNG suppliers just increased their production. The US, for instance, and lots of little suppliers in North Africa or in Nigeria. So this increase in LNG was made possible by the decrease in Asia, in the LNG imports to Asia, and also to South America. I would like to reassure you about the fact that this LNG is expected to continue to go to Europe, because the Asian demand outlook is not really good. We do not expect a fast or full recovery of the Asian demand. I will detail later in the next slide. And on the South American side, actually Brazil was the main driver of the decrease in LNG imports. And it was actually because the year before the weather was very dry in Brazil. And in Brazil, most of the power system is hydro and gas power plants. So when the weather is rainy, there is no need for gas power plants, and then no LNG imports. So I told you that the Asian demand is expected to remain low, and I will explain why. So first of all, it's about the macroeconomic indicator, which are not very good. And you know that China is the factory of the world. And so the Chinese gas consumption is also driven by the exports of manufactured products to the world, and then it is linked to the macroeconomic indicator. Also in China, the construction sector is in poor shape, actually. And the construction sector is linked to cement and steel, which are very energy intensive sectors. So again, a driver for small demand, rather small demand in China. Also, there is an increase in gas supply in China, actually, outside of LNG, I would say. It's about local production, which is under development. It's plus 6% in 2023 compared to the previous year. And also the imports from Russia are increasing through the Power of Siberia pipeline, which is a pipeline which is not connected to the gas fields which are connected to Europe. It's not the same gas. It's not a swap of the volumes. It's really dedicated resources. So there is this pipeline which is ramping up, and this year in 2023 there was this increase of 8 BCM. As prices are going down, we expect China to have some opportunistic spot LNG purchases, but we do not believe that it's going to be high, because they already have a lot of supply. And on the Japan and Korean sides, so we believe that demand is going to stay weak, because in Japan we had the power demand destruction, which is completed, let's say, by the return of a nuclear reactor, which had been shut down following Fukushima. And at the end of 2022 and during 2023 and in 2024, we expect several nuclear reactors to restart. And it's actually a bit the same story for South Korea. It's not restarting nuclear reactor, it's new nuclear reactor and new big nuclear reactor, about 1040 megawatts for the one in December 2022, and almost the same capacity for the next one. So the power sector is not going to support the gas demand in this big driver of the Asian gas demand. So I said that European storages are high, demand in Europe is weak, demand in Asia is weak. So it's a rather bearish picture for the gas price. But let's think about what could change actually. What are the bullish risks for the gas market? Maybe very quickly a small one, it's the Panama Canal, which has a very low water level in one of its main lakes, the Gatun Lakes. And it already triggered a change in the shipping pattern of LNG. It does not have a very big impact for the moment, but it's a situation to monitor. I guess that what is most interesting is the situation in the Red Sea with the attacks from the Yemeni rebels. So it's triggering a change of shipping pattern because the Qatari cargoes are not reaching the Red Sea at the moment. And it is so increasing a lot the time to go from Qatar to Europe. So plus 15 days for one journey from Qatar to Europe, or from Europe to Qatar. So for the moment, it does not have a big impact on prices. So we could say that it's not very important, but it is again a situation to monitor. Another risk is the possible end of the Russian gas transit through Ukraine. Actually, the transit is supposed to end at the end of 2024 from the contracts. So I guess it's not a big risk, but we have to keep it in mind. And the other risks are actually a decrease in production. For instance, due to maintenances, potential unplanned maintenances in Norway or on major liquefaction plants, like we saw in the past years on the Freeport plant, for instance. So some bullish risk, but the picture is rather bearish. Now, if we conclude on the prices, I said that bearish, but to which level? What are the fundamental anchors that might be new levels or limits for the gas price? So right now we are around 28 to 30 euros per megawatt hour for the next months. You can see that the time spreads are very, very low from February to September. Maybe three things. The first one is the fact that gas demand could be supported by the fact that CCGT's gas power plant could become more competitive than the coal power plants, and that's why demand could increase from the power sector. Another question is the fact that at some point when price is decreasing, we might have a demand response. We do not exactly know at which level it's going to happen. And maybe in last resort, if we really have too much gas, if the price is going down, we still have the possibility to shut down some the US, and it would be at around 10 to 15 euros per megawatt hour, but it's really not maybe not today. That's all for the gas parts. Maybe it's time for question.
Yes, thank you, François-Yves. Yeah, we have several questions in the chat. So a first question from the chat. So do we expect the new demand level to become our new baseline, or do we expect a rebound in the coming years? In case of a rebound, could the supply cover it without the Russian gas?
I guess that it depends on what kind of demand we are talking about, and also on the horizon. For instance, if we take this distribution network demand, we will have more and more efficiency measures. We will have more and more penetration of the heat pumps. So and we see that the European citizens are trying to make some efforts to consume less. So I guess that on this sector, we might see maybe not a big rebound in the coming years. Actually, what could change maybe is on the industrial sector. For instance, we believe that some of this demand is completely destroyed, so it's not going to come back, I guess. So at some point, if prices is going really down, we could get back the temporary demand destruction, but for the permanent one, it's finished. I don't know exactly what could be the exact level, but that's the idea. And on the power sector, it's actually really a question, I guess, for the power sector. Maybe a very short answer would be that the development of the renewables is going to continue. I cannot say anything, I guess, on the hydro side. It's really weather driven. And for the development or for the restart of the nuclear reactor, I guess that we will get back some more production again this year.
Okay, thank you, François-Yves. So there are many questions. I'm going to take a second one. So you mentioned Asian energy demand in your presentation. So one question on China. Did China increase its consumption of coal, which also could explain its relatively low demand of energy? So what's behind this relatively limited rebound in China energy demand in 2023?
Indeed, it's one of the possibilities. Of course, there is again several sectors in demand, but for the power sector, the consumption of coal is actually huge and also increased and replaced some of this very expensive LNG. It's actually cheaper to use some of the coal plants rather than the gas ones. Indeed.
Thank you. One question on biomethane. What is the overall impact of the increase of biomethane production on gas demand? Would imagine increased biomethane use to only cover a very small part of the 3/4 of demand reduction mentioned?
Alors, I think I did not mention that biomethane is covering 3/4 of demand reduction. It was combined with other measures. Actually, if I go back to my slide up, so it's biomethane, but it's also the energy conservation measures. It's also the heat pump penetration. It's also price, actually, price. But maybe a quick word about biomethane production. We know that there are lots of disparities between the countries in Europe. For instance, in Denmark, it seems that the biomethane production and injection in the network is counting for about 40% of demand, which is huge. Demand for gas is quite low in Denmark, but it's an interesting point to mention. And we know that in lots of European countries, there are some very ambitious plans to develop this green production.
Okay, thank you. One last question regarding market prices. So even if we observe a decrease on prices, they remain higher than the pre-COVID period. What could be the price floor for the TTF Cal +1, so Cal 25 at the moment? Is it 30 euros per megawatt hour or below 25 euros per megawatt hour? What is your view on that?
That's the 1 billion question. I would say that in some small maturities like months or day ahead, we could have very, very low prices. Maybe not on the Cal plus one, Cal 25. So I would say that my below 25 euros per megawatt hour is maybe too low. But we are not actually far from these levels right now. So difficult to say, maybe between 30 to 25 euros per megawatt hour.
All right. Thank you, François, for your answers.
Thank you.
Don't worry for those who asked questions that were not taken into the stage. We'll answer you by email after the presentation. So it's time to switch to the power part with a small poll again, small survey for you. So question, we talked a lot about gas demand, but what about power demand as well? When do you think power demand will start recovering in Europe? Is it in the first half of 2024? Is it in the second half of 2024? Is it next year? Or is it later or even never? What is your view on that? So let's have a look at the first results. So clearly not in H1 24. We see a majority of votes, above around 80% of the votes in H2 24 or 25. But a small but not insignificant part of you are thinking that power demand will never recover or even later than 2025. That's very insightful. So Etienne, the floor is yours for the last part of this presentation on power and carbon.
Thank you, Julien. Hello, everyone. Glad to see so many of you in this first webinar of the year. It really shows the heightened interest for energy markets and, of course, the rising stakes. So, as François just presented you, the gas market has recently experienced a substantial decline and is still facing bearish risks, actually, and many uncertainties for the year to come. In this last part of the webinar, I'm going to present you how these losses have affected the power and carbon markets, the current state of the fundamentals of both markets, and of course, what you are all here for, our perspective for 2024. So without further ado, let's start with what has been perhaps the most impactful driver of prices over the past months, the power consumption. So on the left chart, you can see the aggregated power consumption for Northwestern Europe, and there is two elements to notice in this chart. First, we ended the year lower than 2022, despite the sharp decline of energy prices. And this is quite striking and interesting to notice. Of course, this was the result of particularly mild temperatures, but still, it's quite significant to notice that despite the massive correction of energy prices, we are still very close to last year. But I think the most impressive point and what really want to draw your focus on is actually the orange dot, which is highlighted by the orange arrow, of course. This represents the so far average load in Northwestern Europe in January. But as you all know, we are currently experiencing a cold spell, and we even had some snow this morning in the Paris area. And so we were expecting this consumption to rise substantially, or at least noticeably. But as you can see, the consumption remains very close to last year. So basically, it means that people held to their thermostat and temperature level in their home, and the industry remains particularly weak. And this, of course, had a very strong impact, a bearish impact on power prices, as you will see later in the presentation. Now, when you look at the right chart, which represents the structural demand, so basically the demand corrected from temperature's effect, this is displayed for France and provided by the French TSO RTE, but you can extrapolate the behavior on the neighboring countries. You can see that the demand has not progressed at all, actually, since over the last quarter of last year, and it remains very close to 2022. So this means that we have not seen any recovery of power demand in the past month, would it be on the energy saving behaviors or on the overall structural demand. And we expect it to last at least over the first part of 2024. Now regarding supply. For once, I'm going to start with the French nuclear situation because honestly, the situation has not changed much over the last quarter. So let's start with the pretty good news. EDF has managed to reach its nuclear output target last year, with the production climbing to 319 terawatt hours, which is a substantial 41 terawatt increase from 2022. So congrats, EDF. However, the availability remains around 50 gigawatts at the moment and is expected to climb to 55 gigawatts by the end of next week, which is still in the very lower end of the historical, if not below of the historical averages. So yeah, we have heard a lot about the improvement and it was quite impressive because EDF really managed to implement efficiently its maintenance and repair program. But overall, the availability remained quite weak for France. And so far, fortunately, it has been offset by the very weak demand. Furthermore, nonetheless, EDF plans to boost its nuclear output of its 900 megawatt nuclear units, which is most of it, about 32 units, by carrying out several upgrades. So first, it intends to extend the period between refueling from 12 months to 16 months, which will improve the availability of the fleet. Second, it also plans to cut by half the duration of these outages from 18 weeks to 9 weeks now. And so this should increase quite substantially the output of the nuclear fleet. On top of that, EDF intends to increase the capacity by 30 to 40 megawatts of 13 reactors, among which 9 upgrades have already been done. So EDF really has optimistic and ambitious plan to improve the French nuclear availability. But nonetheless, and I want to draw your attention on the lower table and lower bar chart, you can see that the targeted output remains rather weak because EDF does not expect the production to exceed 340 terawatt hours this year, which is well below 2019 of 379 terawatt hours. So keep in mind that the availability in France of nuclear power production has increased, is true, but it should keep being monitored closely because any issue materializing, such as the corrosion issue 2 years ago, could quickly drive the availability to very poor level. The second news on the nuclear front was, of course, the agreement between the government and EDF on the post-ARENH mechanism. So as you all know, the ARENH mechanism is a form, which push EDF to sell 100 terawatt hours of its nuclear production at a fixed price of 42 euros per megawatt hour. And this mechanism is scheduled to end at the end of 2025. So to replace it, the government agreed to put in place a kind of a tax on captured prices. So basically, if the captured prices, which is hedged prices, let's say, of the nuclear production exceed 78 euros per megawatt hour, 50% of this excess is taxed by the government and supposedly redistributed to consumers. If the captured prices exceed 110 euros per megawatt hour, 90% of this excess is taxed for redistribution. The problem here is that it leaves all freedom to EDF to hedge its nuclear production as it pleases. And it does not protect really the consumers because we do not know precisely how this taxed revenue will be redistributed. So this new agreement has really provided a good source of debates among the French market, and it's still at the public consultation phase, and still have to go through the European Union legislative process. But for now, there is a strong lobbying against, or at least to put constraint on EDF, strong constraint on EDF to have continue to have a fair market. Moving to what could be the strongest driver on prices for the upcoming years, the renewable supply. So first, the current state of the market. So I think all charts on the slide are very striking. You can see that we ended the year with record high production on all fronts. So on the upper left, you can see that solar production, despite much shorter days, remains way above the previous years. It's even more striking for the wind generation on the upper right, with a very strong and record level of production. And finally, on the hydro one on the bottom left, with France here, but it's quite similar in the neighboring countries, you can see that we have record high wet conditions early January. So all of that combined with a weak demand really concur to keep French hydraulic reserve, which you can see on the bottom right, at historically high levels. You can see that we are really in the upper range, and we still are in January, despite a few withdrawals due to the cold spell. So we are already deep into the winter season, and our reserves are very good. So of course, this participated in driving the power prices down. But what I'm more excited to present to you today is this slide, perhaps the most important one in the presentation for the power side. So the most striking chart, and it's very impressive, and I'm very excited to show it to you, is the upper right one in blue. It shows the number of negative hours and the difference between 22 and 2023, and it's absolutely impressive. You can see that the number of negative hours, so basically hours with negative prices in the day-ahead market, have really surged last year due to two main factors. First, of course, the demand, but we have already talked a lot about that, so it's not of interest here. And second, the soaring renewable capacity across NWE. So, as is noted below the main chart here, the European Union has installed 17 gigawatts of wind and 56 gigawatts of solar additional capacity in 2023, which is, of course, a record high and about 7 gigawatts more what has been installed in 2022. So it's absolutely massive. And this is expected to continue because in 2024, we expect about 23 gigawatts of additional wind to be installed and more than 60 gigawatts of solar to be installed. So it's quite massive, and of course, it has a significant impact on power prices. So you can see it first on the upper small chart, but also on the bottom one. So you can see the number of negative prices is quite substantial in December. This is mainly due to mild temperatures we had this year, let's say last year, a month ago, and of course, the lingering weak demand. But what is more striking regarding the impact of growing renewable capacity on the market is, of course, the rest of the year, because you can really see that as long as they get, the number of negative hours increases quite substantially, especially over the summer. So you can expect this phenomenon to linger, only temporarily curbed if and when we will see a recovery of demand. But so far we have not seen it, and the massive electrification of the market planned by the EU has not materialized yet. So basically, it means that the increase in renewable capacity exceeds largely the increase in demand. And so you can really expect another significant amount of negative hours this year and in the following one. Now regarding prices, so nothing surprising at this part of at this time of the presentation. You can see that we had a strong drop of power spot prices over the second part of December, which is quite usual due to the holidays period and slower activity. On top of that, we had really strong wind events and particularly mild temperatures. But the most striking point in this chart, and really I want to draw your attention on this point, is what happened in January. I already talked to you about the cold spell, but what you don't know is that at the same moment, we had very poor wind production. So this was a perfect test for the power market to see its resilience. And the market has passed it with flying colors because you can see that prices barely exceeded 100 euros per megawatt hour. So often when you want to have an overview of what we can expect in forward prices, you have to look what is happening on the spot market. And basically with very cold temperatures, some up to 5 degrees below normal last week, and at the same time, very poor renewable production, you can estimate, let's say, the upper end of what we can expect in power prices range for this year. And you can see that it barely exceeds 100 euros per megawatt hour, which really gives an idea of what we can expect, even if tensions continue to materialize later this year. Now looking at the forward market. No news there as well. Basically, it followed two kinds of factors. First, the lack of recovery from power consumption. So we had very mild temperatures. We have lingering energy-saving behaviors. as I told you about in the first slide. And of course, we had a very weak industrial activity with a bleak outlook for the rest of the year, but I will talk a bit more about that in the carbon part. You can see that the downtrend of prices have been carried out along the curve and not only on calendar prices or spot prices. It's highlighted by the right chart. And this was also induced by a combination of bearish driver from the fuel basket. So basically, EDF successfully improved its nuclear availability, as I told you about before. We had declining prices on a number of bearish drivers, as François already talked to you about. And of course, we had plummeting EUAs, which you can see in the dashed green curve on the left chart, amid a lack of demand, expectation of increased supply, and of course, growing renewable capacity. So all of that concurred to drive power prices, calendar prices, to not historically low prices, but basically before Ukrainian crisis level of prices. And it's very striking to look at the left chart and how strong and steady the downtrend has been over the past months. So what can we expect for the upcoming year? Well, unfortunately, the cold spell that we are currently experiencing is expected to be very short-lived because, as you can see on the left chart, we are already anticipating above normal temperatures as of next week. And on top of that, we are expecting another wind surge also at the same moment next week. So let's say winter has been really short. Of course, it's not over yet. We still have February, but for now, we have no sign of cold weather to linger into February. Even if we have very low reliability on weather forecast for such horizon. And it means that we should continue to have a very poor demand, at least on the thermosensitive part. And we should have, let's say, weak withdrawals from gas and hydro stocks. So this should concur to increase confidence of the market on the power curve prices, on risk shortage for next year. And let's be honest, the risks are already pretty low. Of course, it's a forward market, so you have also to look at long-term drivers, and they are also mostly bearish with a growing impact of soaring renewable capacity, as I already mentioned before. We have high gas and hydro stocks at the moment, despite being already pretty deep into the winter season. EDF has numerous plans to improve its nuclear availability, and we have a particularly blurry macroeconomic outlook with everything possible. Olivier already presented you 3 very different scenarios, which could lead to very different also recovery of industry in domestic demand. So basically, it would be foolish at the moment not to expect further losses from the power markets if weather continue to be particularly bullish, if we still have no reaction of demand to the correction of prices, and if we have no sign of recovery for industrial sector. So overall, we expect power prices to continue following the gas market, and it will really all be in the end of the gas market. But we have few signs that the downtrend could start to slow down. First, when you look at the winter premium, and it's often highlighted by the difference of prices between France and Germany, which is displayed on the left chart, you can see that we have already exhausted most of its premium for the next winter and even the following one. And this is quite surprising because so far ahead, it's quite rare to see such a low premium between France and Germany during the winter season, because as you all know, France is much more thermosensitive, much more sensitive to temperature changes and much more exposed to its nuclear fleet. So usually we have often an exaggerated risk premium for winter in France compared to the German market. And it has completely vanished over the previous weeks, which really shows that the market is really confident in the risk of shortage for the upcoming 2 weeks, despite, let's be honest, still large uncertainties for the winter 25-26. So basically, there is no more or very few risk premium left for the upcoming winter. So if this is exhausted, we can expect the downtrend of prices to slow down. On top of that, and I already talked to you about it, the French nuclear availability has improved, but remains rather weak, and the targeted output by EDF remains in the lower end of the historical range. So any issue materializing on the nuclear fleet could quickly drive and induce a rebound in prices. The upside is, of course, very limited due to the overwhelmingly bearish fundamentals, but still you have to keep in mind that it's a risk for the power market. I will talk about the industrial sector afterwards, so I would leave aside for now, but also for the CO2, we are already nearly at a 2 years low. So that means that the market are already priced in all the fundamentals, because the carbon market is a very anticipative one. And we are definitely questioning how much left carbon prices can go down. So overall, we have still some downside potential left, but the market should be careful of any issue materializing on the gas supply or nuclear supply. And we could expect prices not to recover, but at least steady at some point when the power demand will react to the lower prices. I see that time is flying by, so let's move quickly to the carbon part, which will be much quicker. So first, when you look at demand on the carbon market, you have to separate utilities from industry. On the left, I already talked about the overall weak demand in the power price, but another subject that impacts the carbon prices is, of course, the parity between gas and coal, which is highlighted by this chart, which is the coal to gas switch prices. Basically, when carbon prices in blue go in the upper end of the range, it means that progressively the gas power plants are more competitive than coal, and coal being more emittive, it's a bearish factor for EUAs, and vice versa. What happened in the past week is that the declining gas prices have really put a downward trend on the coal to gas switch range, which means that progressively the gas power plant has become more competitive, and it has reduced the needs for coal power plants, and hence the expected emissions from the sector. So this has participated in driving the carbon prices significantly down and continue to do so at the moment. Now looking at the industrial sector, which really interests us the most because it gives a longer term view, to say the least, on the demand side of the market. You can see that so far, and Olivier already talked to you about it, the manufacturing PMI, which is a signal of the market's confidence, has been worsening since the beginning of 2021. But since a few months, you can see that it starts steadying. So it's still below 50, which means we still expect a contraction of industrial activity, but perhaps the worst is behind us. And the carbon market being very anticipative, let's say the drop in industrial production is likely to have already been priced in. But with the halt of its downtrend, we could start the downtrend of carbon prices slow as well, because the market will no longer anticipate further downside in emissions from the industrial sector. However, be very careful, because it does not mean that we expect the industrial sector to recover. It just means that, let's say, anticipation of emissions will start to stop. Regarding the supply now, 2024 will be a year with a lot of changes, because as you all know, the Fit for 55 package has been implemented as of January. And this supply, as I said before, a lot of revision for the market. First, in the timeline, what I want to draw your attention on is the compliance deadline. As you all know, so far it was on late April. So late April, all the compliance players had to surrender the equivalent amount of EUAs corresponding to their previous year's emission. And this deadline has been pushed to September. And this is very important, because so far, the first quarter of the year was often marked by support for emissions due to last-minute purchases from emitters. Since there is no longer reasons to buy last-minute allowances over the first quarter, it's very likely that this support will disappear this year and from now on. And so we have no longer a supportive factor for EUAs at the beginning of the year. Second is a free allocation, which has been also postponed from February to June. But as you all know, over the past 2 years, the free allocation has been spread throughout the year. So it's not a really reliable deadline. It's more indicative. Now, regarding the supply, with the implementation of the Fit for 55 package, the EU ETS cap has observed a unique downward adjustment of 90 million tons. On top of that, the linear reduction factor has been raised to 4.3%, which represents a annual decrease of 84 million tons. Of course, this is significant, but this year it's more than offset by the inclusion of the shipping sectors. And why is that? Because the cap has been adjusted to the newly included sector. So basically, the cap has been increased of about a 1 year equivalent of emissions of the shipping sectors. But conversely, for the first and second year, we only require a partial compliance for shipping operators. So basically, they will have to surrender only 40% of their emissions as allowances next year. So mechanically, it increases the supply. On top of that, we have the REPowerEU package. I already talked a lot about it in our previous presentation, so I will no longer go over that. But basically, it increases the auction supply by 71 million EUAs this year. So combined with the lower MSN withdrawals, because it's based on the market surplus and the surplus has been decreasing, all of that leads to a higher supply in 2024 compared to 2023 of 75 million tons, which is quite substantial. Now for our outlook. I think the right chart sum it up pretty well. So we will have lower, or at least decreasing market MSR withdrawals. We have increased supply from partial compliance of shipping sector and REPowerEU. And on top of that, we have a very weak demand. So basically, we expect the market to be looser this year. And this is why we see very few upside potential for EUAs at the moment and in 2025. Next year, so in 2025, of course, the partial compliance of shipping operators will be reduced, and we expect a recovery at some point of the industrial demand, but it will be offset by the growing installations of new renewable capacity and lower MSR withdrawals once again. So we expect a balanced market, short-term balanced market in the upcoming 2 years. On top of that, and this is, let's say, quite a bad surprise for the environment. We had some populist parties with a less environment-oriented agenda being elected recently, especially in the Netherlands. And this could be threatening for the power market. It has not been so far, but it could be if it pushes the European Union to step back on its climate ambition. So this is a risk definitely to keep in mind, because before anything else, the EU ETS is a political market. So far, it has not really materialized as a risk, but it's definitely something you should get your attention on. And to finish, similarly to the power market, we still see some potential of seeing the downtrend start to slow down in EUAs, even more so than power, to be honest, for several reasons. First, the market, even though the higher supply, despite the higher supply and lower demand, should remain slightly short in 2024, depending on how the industrial demand and domestic demand will recover. So it's always difficult to talk about a bearish market if the yearly balance is slightly short. We have a risk on the nuclear fleet in France, of course. The investors have already built back the massive amount of their short position, which was one of the bearish drivers of the past weeks. So it's very likely that at some point they will stop increasing their bearish bet, especially as prices are now back to 2022 levels. The EU DEC 24, which is a benchmark contract of the market, is well below its 1 year average. So if you're a believer in the mean reversion theory, you could say that EUAs at the moment are pretty cheap. And finally, we still expect at some point the domestic demand to recover with low energy prices and the industrial sector to recover, even if it's a much larger uncertainty. So all of that concur to say that, yes, we still have some downside. As long as gas continue to decline, the EUAs are very likely to follow. But at some point, we could see some let's say, floor materialize in the carbon market, even though it's really difficult to say when, since there is no fundamental support for the EUAs. So our main scenario is we expect range-bound prices between 60 and 80 seems a bit far-fetched, but with the volatility of the market, it's still possible during very short amount of time. But overall, we expect steady prices in 24 and 25 and a return to a tighter market as of 2026. If the weather remains bearish, gas prices continue to decline and demand does not recover, we could expect further losses in carbon prices. On the other hand, if we have a quicker than expected recovery of industry, if domestic demand start to return on the power generation side, and the European Union failed to install, let's say, to keep the momentum in installing new renewable capacity, of course, we could see a quicker than expected recovery of carbon prices. But for now, we do not expect prices to go above 80 euros per ton by the end of the year. And that's about it for power and carbon. Sorry to have, let's say, exceed the amount dedicated. Can we still have some time for questions?
Yes, thank you, Etienne, for your presentation. So we are a bit late, but of course we will take some questions. First question for you on the EUA market. What impact could the EU elections planned for June have on the EU ETS prices?
It's a good question, because as I said before, the EU ETS is a political market. So far, the Commission has restated several times that it does not intend to, let's say, have a hand again in the EU ETS, meaning that they do not intend to change now that the Fit for 55 has been passed, along with the REPowerEU, which was an extreme measure to, let's say, intervene again in the in the carbon market. So we do not expect much impact from the election at the moment, but it's still a risk to consider. As I said before, populist party with very weak environment-oriented agenda are emerging. And so if any manage to win elections, manage to win elections, they could definitely push at some point the Commission to change its opinion on the EU ETS. But so far, the European Union really needs this market because it's basically the most efficient incentive to reduce emissions. And it's still, as you all know, one of the main questions and one of the main stakes of the world at the moment. So it would be really surprising to see all these parties have, as a first act, let's say, a drop of the EU ETS.
Okay. Second question on the power and carbon markets, I guess. The metaphor of the falling knife is often used. Shall we consider that it's soon time to grab it and that the bearish tendency will now move to a stable phase?
This is once again a very good remark. Yeah, this is actually a good conclusion of the presentation, because François-Yves already talked to you about that we expect some support at some point when gas prices will reach the coal to gas switch level, because it should increase back the power demand gas for power demand, sorry. It's a similar effect on the power market. At some point, the very low prices should induce a reaction. Of course, so far prices have been really elevated, so people were encouraged to keep a low thermostat. But if prices start to return closer to pre-COVID level, even if it's still a bit far-fetched, they could start again to heat their home higher, warmer at least. And of course, we expect a recovery at some point of the industry. So yeah, in our central scenario, we expect at some point a consolidation phase, which should be closer than further at the moment. But as long as weather remains bearish and we do not use our gas and hydro stock, it's hard to say when the consolidation phase will actually emerge.
Okay. Thank you, Etienne, for your answers. It's now time to close this session with one last satisfaction survey. So just if you can just take a few seconds to rate this webinar, it's really important for us to have your feedback, really valuable for the next editions. Don't hesitate to leave some suggestions for the next webinars in the chat. We'll close the vote in a few seconds. So thanks to those who took the time to answer. It's now time to close the session. We'll meet again in April 24 for the second quarterly webinar session of the year. I hope you enjoyed this one, and see you soon on our EnergyScan platform. Goodbye.